Hello everyone, welcome back to the channel. Today we delve into a fascinating story that has economists excited and ordinary people baffled, the so-called Irish economic miracle. You've probably heard of Ireland as one of the richest countries on the planet, with sky-high GDP figures that make it seem like everyone is rolling in money. But is that the whole picture? In this video, we'll explain it step by step. We'll see how Ireland went from being one of the poorest nations in Europe to a global power. Let's start with a bit of history to set the stage. Back in the 1980s, Ireland was struggling big time. Unemployment was hovering around 17%, public debt was through the roof at over 100% of GDP, and the country was dealing with emigration waves as young people fled for better opportunities abroad. It was nicknamed the poor man of Europe. But then, something shifted dramatically in the mid-1990s, kicking off what's now known as the Celtic Tiger era. This was a period of explosive economic growth that lasted until about 2007, with annual GDP increases averaging around 7 to 10%. What sparked it? A combo of smart policies and lucky timing. First off, Ireland slashed its corporate tax rate to just 12.5%, one of the lowest in the developed world. That made it a magnet for foreign direct investment, especially from American tech and pharma giants like Apple, Google, Microsoft, Pfizer, and Intel. These companies set up European headquarters in Dublin and other spots, bringing in billions in capital and creating tens of thousands of high-paying jobs. Being part of the European Union since 1973 helped too. EU funds poured in for infrastructure, and access to the single market meant Irish exports could boom without tariffs. Plus, Ireland's English-speaking, well-educated workforce, thanks to free university education and a focus on STEM, was a huge draw. Add in deregulation of industries like telecoms and aviation, and you had a recipe for rapid expansion. During the Celtic Tiger years, Ireland's economy grew faster than almost anywhere else in the OECD, turning it from a backwater into a high-tech hub. The results were stunning. Unemployment plummeted to under 5%, and per capita income shot up, surpassing the UK and even the US in some metrics by the early 2000s. Exports exploded, particularly in software, pharmaceuticals, and medical devices, sectors where Ireland now punches way above its weight. Think about it, a country with just over 5 million people became home to operations that handle a massive chunk of global data and drug production. But like any tiger, this one had claws. The boom fueled a real estate bubble, with property prices tripling in some areas. When the global financial crisis hit in 2008, Ireland's banks were overexposed to bad loans, leading to a brutal recession. GDP contracted by about 8% in 2009, unemployment spiked back to 15%, and the government had to bail out the banks, ballooning debt to 120% of GDP. Ireland even needed a €85 billion bailout from the EU and IMF in 2010, with harsh austerity measures that cut public spending and raised taxes. Fast forward to today, though, and Ireland's bounced back stronger than ever. By 2014, growth was positive again, and the economy has been resilient through challenges like Brexit, the pandemic, and recent inflation. As of 2025, projections show GDP expanding by anywhere from 2.3% to over 4%, depending on who you ask, like the IMF at the lower end or Bank of Ireland at the higher. Modified domestic demand, which strips out some volatile multinational stuff, is expected to grow around 2 to 4% too. Unemployment is super low at about 4.2%, and employment is at record highs with over 2.7 million people working. Ireland's GDP per capita is one of the highest globally, around $106,000 in recent years, putting it ahead of the US's roughly $80,000. The tech sector alone employs over 300,000 people, and pharma exports are massive. In fact, Ireland produces about 25% of the world's diabetes medications and is a key player in semiconductors through companies like Intel. From a US viewpoint, this looks a lot like Silicon Valley meets Wall Street, but on a smaller scale. American firms love Ireland because of that low tax rate and the ability to shift profits there legally, avoiding higher taxes back home. It's why so many US multinationals route their European operations through Dublin. And it's paid off. Ireland's run budget surpluses in recent years, like €8 billion in 2024, allowing investments in infrastructure and a sovereign wealth fund for future pensions. Immigration has helped too. Net migration is positive, bringing in skilled workers from around the world, much like how the US benefits from global talent. But here's where the miracle starts to look a little less shiny. Critics argue that Ireland's wealth is overstated, and the average person isn't feeling as rich as the headlines suggest. This is where we get into leprechaun economics, a term coined by economist Paul Krugman back in 2015 when Ireland's GDP jumped 26% in 1 year, not from real growth, but from multinationals relocating intellectual property and assets there for tax reasons. GDP measures economic activity within borders, but in Ireland, a huge chunk comes from foreign-owned firms that book profits here but don't necessarily create proportional local benefits. Things like aircraft leasing, Ireland's the global leader, and pharma royalties inflate the numbers wildly. To get a truer picture, experts use modified gross national income, or GNI, which adjusts for these distortions. In 2023, Ireland's GDP was about €500 billion, but GNI was closer to €250 billion, half as much. That drops per capita GNI to around $70,000, still high but more in line with countries like Germany or Sweden, not the outlier GDP suggests. Inequality is an issue too. While top earners in tech thrive, wages for many haven't kept pace with costs. Poverty rates are around 13%, and child poverty affects 1 in 6 kids. Then there's the elephant in the room, the cost of living, especially housing. Ireland's facing a severe housing crisis in 2025, with prices rising for the 21st straight month, up nearly 8% year over year as of May. In Dublin, the average home costs over €500,000, and rents are insane, more than €2,300 a month on average, twice what they were during the Celtic Tiger peak. Why? Supply can't keep up with demand. The central bank says Ireland needs 52,000 new homes a year, but only about 33,000 are being built in 2025. This is driving young people out again, emigration is ticking up, and even hurting businesses, as tech firms struggle to attract talent who can't afford to live there. Utilities, groceries, and transport are pricey too. Overall cost of living in Dublin is about 20% higher than in Chicago, for example. Geopolitics adds risks. With so much tied to US firms, potential changes like higher corporate taxes under a new administration or trade tensions could hit hard. Remember, Ireland's economy dipped into recession in 2023 due to global slowdowns and multinational volatility. And while growth is back, it's uneven. Domestic sectors like retail and construction lag behind the export behemoths. So, is the Irish economic miracle real? Absolutely, in the sense that smart policies turned a small island into a global player, creating jobs and wealth that lifted millions out of poverty. But it's not without flaws. The GDP hype masks distortions, and everyday challenges like housing show that prosperity isn't even spread. For Americans, it's a reminder that economic stats don't tell the whole story. Think of our own debates over wage stagnation amid stock market highs. Ireland's story is inspiring, but it's a nuanced one, a miracle with some asterisks. If you're thinking of visiting or investing, do your homework. What do you think, miracle or mirage? Drop your thoughts in the comments, like and subscribe for more deep dives, and I'll see you next time. Peace out.